Welcome to episode 6 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I'm Rachel Johns.
Let's dive in.
All right, Eric. So this is part 2 of our rapid fire round. Hopefully both of us have an opportunity to save some face here.
I wasn't pleased with my first round.
Well, you get to quiz me first. So
Ooh, that's good.
here's hoping I get one.
All right, STCG. It's not a very common
Okay, I think
acronym.
I might know this, and if I do, shout out to mom and dad. Short-term capital gains.
Yes, ma'am.
All right.
Can you tell us what it is?
It is when you sell your stocks for what is determined to be the short term.
Can you
And so
tell
you're
us what a short term is?
less than a year.
Yes, that's accurate.
Yeah.
That's correct. And what is the tax rate that you pay on something that you hold for less than a year and sell?
Your ordinary income tax.
That's fact. Just to be clear, it's not only stocks, it's any security. So bonds count as well.
Fair. Okay.
All right. LTCG.
The long-term capital gains.
All right. What is that?
When you have held it for longer than a year.
Got it. What are the differences in the tax rates?
You have to pay the capital gains tax rate.
Can
Which
you tell,
are
right?
okay, wait, let me see if I can remember. I want to say last episode it was like 5, 15, and 20 or something like that.
Close.
Okay.
0, 15,
15
and
and
20.
okay.
Yes. And then there's
Yeah.
extra 3.8% net investment income tax.
Oh yeah.
If you're over 200K
I never
single,
knew.
250 married, filing
I
joint.
didn't know that.
That's all right.
Yeah. Good job, mom, dad.
Yeah. Shout out to Deb and John. All right. Realized gain and loss. What is that?
So that is the comparative difference between your basis or what you like purchased the security, I guess, for
Sure.
and the sale price.
Exactly. Well done.
Thank you.
What is an unrealized gain or loss? Do you know when we might see that? What is that?
When you've seen stuff in your portfolio go down or up, but you're not yet selling it to realize, like you might see your portfolio going down, but you're like, you know what? I'm just gonna grit my teeth and wait for it to like swing up again. So I see the losses in my portfolio, but I'm not realizing them because I'm not cashing out.
That's exactly right. The only point that I would want to make there is that what you said is exactly how people think. And I would push back a little bit that you can do what's called tax loss harvest. Wow. Tax loss harvesting, which is you actually sell things when they're down and then buy things that are similar, but not substantially similar by the IRS's definition, but you can get away with
substantially similar, like the same company.
correct. You
Okay.
can't sell it and then rebuy it.
But like, could I sell Walmart stock and buy Sam's stock?
Aren't they the same company ownership?
I don't know how the thing. They're separate companies when I go shopping.
You
They
could
hit
go
my
Walmart
bank
and
account
Target
differently.
or
That's not
Walmart and Costco. You
well.
can go another
I
retailer.
specifically
Sure.
tried to go Walmart and Sam's because I knew that they're owned by the same human. I don't know if he has two different. I don't know if they trade differently.
That's me.
Do they have two different tickers on the stock exchange?
No.
Okay, well then, fair point. Okay, but like, let's say all retail goes down. I'm selling my Walmart stock. I'm gonna go and purchase Target. Although I would have a hard time with somebody telling me Walmart and Target are similar. Have you been in both?
Yeah.
Okay, so
Close-ish.
no.
In my mind, it's close enough.
Well, for most of the female listeners.
But anyway, the point
Yeah.
that the point that I was trying to make though is you typically do want to sell when they're down. Take the tax loss. It's not an actual real loss, and then you're jumping right back in it.
Buying at a discount, essentially. If the whole market's down, you're buying cheap, right?
You're not really buying at a discount. You're just lowering your cost basis. And you're taking the tax loss that you can use to offset ordinary income at a rate of $3,000 a year, and you can carry the rest forward to use to offset
In
gains in the
perpetuity?
future. So,
I can carry the loss forward in perpetuity.
yes.
Okay. Good to know.
Yes, ma'am. All right. What is the federal funds rate or the discount rate?
Something I've definitely heard you say before. I can't for the life of me remember the context. Okay, federal funds rate, discount rate. When the government really wants us to put money back into the economy. So they're trying to incentivize us by doing something. They're discounting something. Am I
Oh,
anywhere
I
close?
like that you're using just words
Thank you.
related and going with that.
I'm using
Um,
actual words.
it's the rate set by the Fed, the central bank, right? The United States federal.
Okay.
Wow. Um, it's the overnight borrowing rate for banks. So if a bank has a shortage in their capital reserves and they need to shore that up overnight on a very short term, ultra short term basis, they can go to the Fed's borrowing window. And the Fed charges an interest rate based on this, right? The Fed will pay the banks this interest rate for offering up their extra capital, their excess capital to the Fed.
What happens when all the banks fail?
Well, I mean, that's a very separate discussion that has very little to no bearing on this.
Well, I mean, that no longer really becomes an option, right?
If all of the banks failed, yes, this would not be. I mean, like, yes, then we would care a lot less about the discount rate. But what this does is the banks take their extra capital and they lend it to the Fed overnight, and then they lend it essentially to other banks overnight. What this does is it sets a floor on borrowing. So now the banks are going to want to lend money to consumers at a rate that is lower than what they can get from the federal government overnight, completely risk free, because it's the federal government. Fed just prints money. Well, theoretically, if Congress doesn't hold it up, they print money
Right.
to cover these loans, right? So they're thought to have no default risk, no counterparty risk there. And then if the rate's higher than the rate's always going to be lower than the consumer rate, because the banks are going to have a premium for the risk premium that they're going to um, encounter when they try to lend to consumers. Because you or I could default on a personal loan to a bank, the Fed's not, especially because they're ultra short term. Again, they're overnight. So
Yeah.
anyway, this sets a floor for interest rates. So if the federal funds rate is right now between like 5 and 5.25, they set it within a range, a 25 basis point range or a quarter percentage point range.
Okay.
And that sets the floor for what the prime rate could be. So the prime rate is usually going to be the federal funds rate plus some number. So maybe like the 30-year mortgage rate, it will never be lower than like the federal funds rate. So the federal funds rate is 5 to 5.25. The prime rate might be like 7, 7.25, something like that. That's like 200 basis points or 2 percentage points higher than the Fed funds rate. But anyway, yeah,
Okay.
that's the Fed rate. All right, the risk-free rate. Have you ever heard of that?
When you asked me about it a minute ago,
So what would you say to that?
it is um related to what you just said.
Yeah, very much. Risk-free rate is typically thought of as the rate that you would borrow. It's like the T-bill rate, the short-term treasury rate, because it's thought to have no default risk. And it is you would have to get a premium over this if you're going to invest in another market that is not just short-term T-bills.
So how does
So again,
this
we're trying to
rate
set.
compare to the overnight rate that the Fed is offering to the banks?
It's generally thought of as very similar. The T-bills are going to be either plus or minus usually plus a very small margin over the discount rate. The
Okay.
only exception to that is like right now you've heard a lot of talk about the inverted yield curve, and what that means is that the rate that you would get on 10 years, you typically would be thought of as having like a time premium. So if you're going to have your money invested for longer, there's some uncertainty there, and you would want to gain a little bit of return for that uncertainty. But in times like that, like we're currently in today, the 10-year rate is actually lower, closer to 4%, and the 2-year rate is a lot closer to 5%. So
Hmm.
that is to say that the markets, believe that the economy, that the federal funds rate right now is kind of artificially high, and that it will lead to slower economic growth, reduced inflation, and then they will have to lower that rate. So the expectation is that it's not going to stay this way for long. That's what kind of it means when the yield curve is inverted.
Okay. I don't think I could say that again, but I appreciate the knowledge.
All right. What's a GRAT? GRAT. GRAT.
And annuity trust.
Yeah.
Okay.
Grantor retained annuity
There we
trust.
go.
Yeah, well, wow. I'm surprised. Well
Thank
played.
you. This brings me back to the CFP studying days for you.
Right. And this is like a trust instrument that you would use in estate planning if you
Hmm.
thought that the grantor would outlive the term. So you set a trust, you give the thing at the discounted future value, and then it's complicated, and we get estate and
Sounds
tax
it.
attorneys involved,
Okay.
but it is an estate planning tool to essentially reduce the value of the estate, get the assets out.
Got it.
What is an ILIT or ILIT?
Um, do either of the I's have to do with insurance?
Yes.
Okay. Does the T have to do with a trust?
Yes.
Okay.
We're getting somewhere?
Um, does the L have to do with living?
Sure.
Okay.
Kind of.
Kind of.
I mean, it's not a living trust, but
Okay. Lifetime.
close enough. All right. Irrevocable life insurance trust.
Okay, okay, okay.
So this is when you transfer a life insurance policy or you buy a trust and then buy the life insurance policy within the trust. And what you're doing is you are an irrevocable trust is separate from the estate. It's considered a completed gift, right? At the time
Mm-hmm.
you do it. So you gift to the trust, and then the assets that are inside the irrevocable trust are excluded from your estate. So if you have an estate issue, you can pay premiums. There's something called crummy letters, which means you can use the present year taxable exclusion, which is currently $17,000. You could pay that on behalf of the beneficiaries of the trust to the trust, and you can use it as a present value gift. This is again complicated. Let's just say it's an estate. It's a way to reduce estate tax. If you're having state tax liability because you're bumping up against the over 13 million, it's like 12.9 or so this year. It's going to increase until 2026, and then it's going to be cut in half because the Tax Cuts and Jobs Act is going to expire,
Expire, yeah, okay.
and then it's going to be cut in half. So you'd
So
have
it
more
sounds like there's
remission.
a lot of ways though for that estate planning piece to really come into play that can be kind of complicated and would require a variety of experts in their
Yes,
fields.
yes, variety
Yeah.
of professionals coming together to
Yeah,
make it.
yeah, exactly.
So I guess I just answered this. What is an annual exclusion? What is this current year's annual exclusion, I should say?
Um, is that the millions that you were just talking to me about?
That's the lifetime, sure. What is like
Oh,
this year? If I want to give a gift and not file a gift tax return, what is the max amount I can give?
oh Lord.
I said it like 30 seconds ago.
Okay, well,
That's all
I
right.
was
It's
Googling.
17,000. What's the lifetime exclusion?
That is going to be 20 million.
No, close. It's
15 million.
12.9 this
Okay.
year.
Well,
Round it.
I was going to say 13.
All right, what is an option? You've heard of stocks. What is an option?
That is a an opportunity to buy a stock.
That's sure that'll work. That's called a call option. It's a contract. It's a contractual
There's a put
obligation.
option too, right?
Yes,
Okay.
that's correct. Yes. What is a
Okay.
put option?
The opportunity to sell
That's
a stock.
exactly right.
Okay.
That's exactly right. So a call is again a contract to buy a stock at a
At a certain
predetermined
price,
price.
right? Okay.
Yes, and then it's typically going to be higher than the today's trading price. So if a stock's trading at 100, you might buy a call at like 103 or 105. And then if the stock goes above 103 or 105, let's call it 105. So we buy a call at 105. And then there's a certain amount of time for that contract.
Okay.
The longer the time frame, the more opportunity you would have for the stock price to, move, and
Reach that
therefore
number,
it's going
yeah.
to be typically more expensive. But anyway, the if the stock's at 100, you buy 105 exercise price call option. Then if it goes above 105, you can exercise the call, and you will get you'll be able to buy the 100 shares of per option at the $105.
Okay.
Does that make sense? So if it goes
Yes.
to 110, I'm getting $5.
So you
I'm
get
going
to
to make a
purchase
$5
at like
profit.
a,
Yeah,
yeah,
a discount.
discount. Yeah.
All right. And then what is margin? A lot of people talk about buying on margin or selling on margin, but you typically hear about buying.
Um, you are buying on the outsides. The bumpers. Um, okay, does it have to do with like extra cash that you have from a sale?
Close. It has to do with extra cash.
Yeah,
You're actually borrowing that cash from the institution, typically, that you're buying through.
got it.
So if you're buying on margin, you're taking a loan, and there's specified margin rates based on your amount of capital with the investor, I mean, with not the investor, with the institution,
Yeah.
how much they trust you, essentially. It's kind of like a loan, right? So it's like a personal loan, and typically they're short term, and um, there are additional requirements that you would have to
Do they
put up
use
additional
your
dollars
like
if
credit
you're.
score to determine those
That
things?
is one factor. Yes, I
Okay.
believe so. Believe so. All right, that's it for your questions. Well done.
Oh, thanks. Okay. So I have some acronyms, some real words, and then I, of course, have three of my fun ones, like the ankle biter ones from last time. Okay. So diversification.
Okay. That is now. It's been accepted since. How granular do we want to go here? It is the thought
Not too
that.
much. I feel like you could do an entire podcast on
Right.
diversification.
And we
So
probably should, to be fair, but it's
I'll be coming up.
the thought that you should not have all of your eggs in one basket. That's probably the simplest way. They explain it like in five way to think about things, right? If you have all of your investment in, for example, a company like Enron, and then Enron stock goes to zero, you
Yeah,
are now left with $0. However, if you had, 5% of your investment in Enron and you had $100,000, you've now lost $5,000, and now you have 95,000 left in the other investments that you put
sure.
your
The other
dollars in.
baskets. Okay. What about amortization?
Amortization is the reduction in value of an intangible asset on a yearly basis.
So you'd see that on like your tax return or something like that?
Yes, you'd see it on your balance sheet
Okay,
and
fair.
could potentially see it on your tax return,
Yeah.
yes. Amortization of taxable bonds is a deduction in the current year.
Okay. So then that can go and lead pretty well, I think, into depreciation,
Sure, depreciation is reduction in value of a tangible asset on a yearly basis.
which is more likely to be on that tax return.
Right. It's typically thought of as like you deplete an asset, capital asset over time. And so as you use and deplete the asset, the government is willing to give you a bit of a tax write-off,
All
a
right.
little bit of a break.
What about compound interest?
Compound interest is the idea that if you gain 5% interest this year and I have $100, I now have $105. So the interest of that $5 is going to earn interest. And if you extrapolate that over a number of years, right, then you are, compounding your interest because your interest is gaining interest and then that interest is now gaining interest, right? So it's
Got
like
it.
exponential growth of
So
the
it's the
interest.
argument that just because I made my $5 because it was 5% of 100 doesn't mean my growth. I mean, I'm always going to get $5. I should be getting more and more each year because I'm getting it on a larger pot.
Correct.
Okay. Purchasing power.
Purchasing power is thought of as um, kind of what inflation does to your dollars over time. So inflation makes your future dollars worth less than today's dollars. So if you want to have the same purchasing power today as you do in the future, then you would want to be at least keeping up with inflation. So if inflation, a couple like I guess in 2022 is around 9%. So I would need to have 9% more dollars to have exactly the same purchasing power.
Ooh.
So like if my budget is what 10K a month, now I need to have I need to be able to supply $10,900 a month if we're talking about a 9% return, right? To be able
Hmm.
to purchase the same amount of things. That's the idea.
This reminds me of our why you should ask for a raise podcast that we did
Yes.
earlier. Yeah.
Yeah, absolutely do it. Still do it.
Okay.
Unemployment
Um,
rates unemployment rate is still historically low. I think it's like a
sure.
70-year low. So still ask for a raise. Now is the time.
Okay. So what about I've got some acronyms for you. You ready?
Let's do it.
CapEx.
Capital expenditure.
Yeah.
Yeah.
I'd never heard it like that. Okay. ACH.
I think it stands for automated
That's
clearinghouse.
exactly what it does stand for.
I always think of it as like an online check, but
A CD.
certificate of deposit.
Okay.
Short-term borrowing from a bank at a predetermined rate for a predetermined set of time or period of time. It just ties up the capital.
CTC.
CTC.
Hmm.
I don't know that.
You do know it. You just don't know that accurately.
Sorry. Maybe
Uh,
not.
it's a credit,
Um, I don't know.
the child tax credit.
Oh, yeah. Okay.
Yeah.
Child tax credit.
I've never seen it
2000 per
as an
child.
acronym. Yeah. We we claim this regularly.
Right.
Okay. What
It's
about
capped at 6,000, right?
an HSA?
Health savings account. has to be accompanied by a high deductible health plan. But it is great. They are fantastic vehicles to use for savings. There's actually some planning surrounding that. We should actually do an episode on that, talking about it. But brief
HSAs.
rundown on HSAs. You can keep your expenses. The HSAs kind of act as a Roth IRA that has deduction on the front end as well, as long as they're being used for medical expenses. So
Mhm.
what that means is it reduces your taxable income in the current year, and the growth is tax deferred and then tax free for medical expenses. So what you want to do actually is you want to keep a log of your medical expenses, enjoy this tax free growth, and then pay for the medical expenses out of accounts that would have tax drag on them, like brokerage accounts. And then you would later in life, like in your 50s or 60s, you would want to just take all the money out of the HSA that's grown tax free on all the earnings
It does
for
sound.
those
I do
things.
think we need a
It's a
podcast
lot.
about
It's a lot, sure.
yeah, that and just I think the benefits packages generically. Okay, one more acronym and then I'll give you my three ones that you're
Okay.
gonna make fun of me for. Okay, let's go with T-bill.
T-bill is just a treasury bill.
All right, you ready? Have you ever heard of big uglies?
No. Should I have? I
So
mean, maybe, but it
big
was college and
uglies,
we weren't being nice.
rude, terrible. No, big uglies are typically solid investments with steady returns, but they are in dirty sectors like mining, steel,
It's
oil.
cigarettes, sure.
Yeah, exactly.
Got it.
So they're called the big uglies.
Never heard them referred to that way.
I love this website.
Okay.
What? The cockroach theory.
I mean, is this the idea that like in a nuclear holocaust yeah, like a nuclear winter that you would have cockroaches surviving, so we should be investing in things that are similarly useful, like butter and guns and ammo?
Okay, so actually that's not a bad guess. It actually is the idea that when a company reports bad news, usually there's much more behind the scenes. So think subprime lenders circa 2007.
Okay.
So if I'm willingly showing you like this one piece, right, it's the tip of the iceberg. Like there's a
Got it.
lot of dirty stuff happening behind.
Okay, that's
Okay.
kind of interesting.
And the last one, which is my favorite of all of them, is the puke point.
That's disgusting.
Well,
Like,
that's not my favorite because it's like not disgusting, but it's the most logical progression for me. It is the idea like when an investor can't stomach the losses any longer and decides to sell despite steeply falling prices.
okay.
So it's the point in time when you
Got
as
it,
an
got it, got it.
investor are
Sure,
just like,
sure.
I'm done. My stomach is
Makes
no longer
sense.
steel. So it's
Sure,
your
that makes sense.
personal
So
point.
you're gonna go ahead then and sell at the worst time. Got it.
Correct. So think maybe GameStop, like
Yeah.
your friends who are
Right.
ready to ride that into the
Right,
sun.
right.
All right. I love it. So it looks like we got some ideas for some new podcasts from this after all.
Yeah. And thanks for listening as always, guys.
Yeah.
And you can see us, or I mean you can contact us at eric@equilibriumfp.com. Our website's equilibriumfp.com. Send us an email, send us some questions, and we hope to hear from you.
Yeah. Till next time.
All right.